We'll probably do that when we come back from break. And then we're going to start monetary unit sampling. I will send out the Chapter 3 exam. Hey. Chapter 3 exam will be emailed after class. And it is due Friday, which I think is about a week away. A little more than a week away, 9 days away or something like that. Anyway, so this will be emailed after class. Chapter 3. Make that red. Okay, so chapter 3 is now going to be emailed. Okay, so let's go ahead and start in on the chapter 5 handout evidence. Okay. Okay, so we're going to start out with inherent risk. We're going to go over the risk first. And what you basically do is gather evidence, and you're always trying to get risks low. You're trying to reduce the risk. You reduce the risk if the financial statements are misstated. So you always want the risk to be low. However, you don't have control over all the risks. There's things out of your control. There's things the client does that are out of your control. So we have to self-assess the risk so that we know how much evidence to get. It looks like I'm falling off a cliff here or something. I did something funny with my camera. Anyway, so we're going to talk about the risks first, and then we're going to get into what the evidence is that we need to mitigate that risk, to bring that risk down. Okay, so let's go over the risks first. We'll talk about inherent risk. Okay. Inherent risk is the risk that a material misstatement will occur, and it's not said, but it probably should be that this is before I'm gonna put that on a second line. Let me do something here. Okay, so inherent risk is the risk that a material misstatement will occur. And this is before we take into account the internal controls or an audit of the financial statements. So what is the risk that a material misstatement will occur? So this is generally for people who are making the journal entries, recording transactions, that sort of thing. Okay, so inherent risk. This is a risk that a material misstatement will occur. And we're going to go through some of the different types of transactions and see where they would fall for inherent risk. Okay, routine transactions that happen every day, sales, purchases. Is the inherent risk low, do you think, medium, or high for those?
Low risk.
Probably low. You walk into Walmart, you buy a pack of gum. Routine transaction happens every day. Probably no one's going to mess that up. And quite honestly, certainly not going to be usually a material mistake. So routine transactions are usually pretty low. Things that happen every day, sales, purchases, all that kind of stuff. Non-routine transactions. Services paid with stock. So for instance, someone does a service for you and you give them company stock. Probably doesn't happen every day. What level of risk would that probably be?
Maybe high because the stock market is fluctuating.
Yeah, this would be high. It's whenever you see non-routine, things that don't happen all the time, it's something new. And because it's non-routine, it's something that it may be more questionable how you actually account for it. So they'll probably be high. Okay, estimation transactions, things like depreciation, bad debt, etc. This one's a little bit tricky. It's got one thing going for it, it's got one thing going against it.
Hmm.
I'll tell you what it has going for it. Going forward is this is a routine transaction, right? We do depreciation expense, that's done every all the time, every year. Bad debt expense, same thing. So it's routine. However, it is an estimation. It's not an exact number. It's not like they sold a pack of gum for $1.20 and that's all it is. Depreciation, you have to think about depreciation. You have to estimate how long the thing's going to last for, what it's going to be worth at the end, what kind of depreciation are you using for it. So there's a lot of up in the air things. It's very hard to look at an asset. Probably a bad one, but it's hard to look at an asset and know how long it's going to last. How long is where's my calculator? No one even uses a calculator anymore. I don't know why I'm looking for it. Here it is. How long is a calculator going to last for? So it has that estimation part. That is difficult, but it also is routine. We do depreciation entries all the time. Where do you think this one would probably fall?
I would say either medium or high. It can be low.
Yeah, it would probably, I think medium is probably a good one for that. And you're right; it could almost land anywhere in here depending on what it is. But it probably it is routine. However, there is this estimation thing. We don't have a crystal ball. We don't know how long the calculator is going to last for. So this is probably medium.
Mm-hmm.
Complex transactions. For instance,
Low.
probably high.
Yeah.
Yeah,
Okay.
because for instance, like if you buy a competitor or something like that, and this really has two things going against it. A lot of times, complex transactions, although they could be routine, a lot of times they're not. And purchasing a competitor, there's always uncertainty in that. The same uncertainties you have with your own company are going to be multiplied by those too. And it probably doesn't happen that often. So, and you run into weird things too. For instance, purchasing a competitor, they have a patent for making orange juice. What's that worth? So you can also run into these kind of strange things. They don't have the patent on their books because usually that's all expensed when they make a patent. But when you're buying it, maybe it's a significant part of it. Well, how do you value a patent on how to make a certain way to make orange juice or something? So you can run into these complex transactions, and those would generally be a little bit higher. So when you're looking at these inherent risks, it really kind of it boils down to where are you likely going to have problems. Okay, now control risk. Ideally, if you do have an inherent risk, that the material misstatement occurs, ideally, it'd be great if the client's controls caught it. So the control risk is that they don't catch it. Control risk that the client's internal controls will fail to detect a material misstatement. From inherent risk. So if there is a material misstatement that happens, sorry, here in the middle of the thought. If a material misstatement does happen, up here, one of these occurs, how likely is it going to be that the control risk fails to detect it? Now, usually they should. They should be able to detect a material misstatement. So for instance, let me give you an example. So here I got my calculator, and let's say it costs $6. Instead of putting it on the books for $6, I put it on the books for $6 million. Material misstatement, let's say. Okay, now ideally, the system should kick out something that detects that. I just put in a $6 calculator for $6 million. If nothing else is going to show up on somebody's budget, they're going to say, "What's this $6 million charge doing here?" It's this. It's a calculator misstatement. So things like budgeting and that sort of thing are things that you might find material misstatements showing up on. But ideally, if a misstatement does occur, material misstatement does occur, the client's internal controls will detect it. And that's what they design their controls to do, is to detect those things. Okay, so a control risk is the risk that it doesn't, that they fail. And by the way, for all of these, what do you want? You want the risks, we always want risks to be low. You want low risk. Let me put that way. So you want it to be low. You want them to be able to catch, the internal controls hopefully will catch whatever they're looking at. I'll copy this up here. You want this risk to be low too, right? The inherent risk. You want it to be low. What's the likelihood that they're going to make a material misstatement? Well, let's hope they don't. I shouldn't say hope. We want it to be low, that they won't make a material misstatement, and that if they do make one, we want it to be low, that the controls will miss it. All right, now here's the thing about inherent risk and control risk. There's two things about it that are important. Do I have room? Probably. Inherent risk and control risk can only be assessed by the auditor. The actual inherent risk and control risk cannot be changed by the auditor. Oops. Hey. Okay. So these inherent risk and control risks, these are out of the control of the auditors. And actually, you say, "Oh, okay, the client's in control." Actually, the client is at this point. The client won't even be in control either. And it has to do with we can't. If there was an inherent risk that happened in March, let's say in March something happened, and we had this inherent risk that people were making the wrong transaction, or whatever. We can't jump in the time machine, go back and change it. The client can't jump on the time machine, go back and change it. Going into the future, the client can hopefully do more training to reduce inherent risk, can beef up their controls to try to catch if there is a material misstatement. However, we can only assess what it was during the year, the inherent risk and the control risk during the year. And if there was a problem in either one of those two, we can't change it. We can assess it. We try to assess it and see what the problems, what the likelihood of problems are. We try to assess it, but we cannot change the actual inherent risk or control risk. And truthfully, the client can't either. Going into the future, the client can, but the client again has the same problem we have. We can't jump in the time machine, go back, and try to redo those in that period of time. So we only can assess it. We cannot change the inherent risk or control risk. The CPA exam, sometimes one of their questions they'll say is, what should the auditor do? Raise the inherent risk, reduce the control risk. Those are bad answers because you can't do either of those. Okay. So we always want risk to be low, and we cannot change the control risk and the inherent risk because A, they've already happened, and B, they are not under our control anyways. They're under the clients, but even the client can't change them at this point. They can change them going into the future, but not going into the past. Okay, now, so you say, well, okay, as an auditor, what can we do? Well, that sort of the detection risk comes up. The detection risk is that the auditors will fail. So the auditor will fail to detect a material misstatement, and these are misstatements that come through the failure of control risk, inherent risk and control risk. Okay, so a material misstatement occurs. The controls don't catch it. The auditors are the last hope of catching the material misstatement. And if the auditors don't catch it, it goes on a material misstatement will appear on the financial statements, and that's the audit risk. So this look, big obnoxious capital letters. Oops. Control may be a bad word. What's a word that means control? Let's get some. Let's say change. Oops. Gotta keep in. So detection risk, this is the only risk that we can change. We can increase our audit procedures. We can get more evidence. We can change the detection risk. We can't change the inherent risk, can't change the control risk. We assess them, but we can't change them. We can change the detection risk. Instead of taking 50 things, we take 150 things to look at. And hopefully, the more things that we look at, the more evidence we get. If there is a material misstatement, we'll find it. So the detection risk is the only risk the auditors can change. All of these risks go together in the audit risk. Oops. Who's going to keep going? Audit risk is risk that an undetected material misstatement. I'll clean this up in a second. Appear on the financial statements. Okay, so audit risk is the risk that an undetected material misstatement Now, if we detected a material misstatement, we put it in the audit report, that's fine. You know, if we give them a qualitative audit opinion or a adverse opinion. I'm sorry, qualified. That's what I meant to say. I was showing you what a instructor that didn't know what they were talking about would say. So a qualified opinion or a adverse opinion. So if it's detected, it's fine. But if it's undetected, the auditors don't know about it, and it appears in the financial statements, that's the audit risk. That's the risk that the financial statements are misleading, and we have given a clean bill of health to the on the audit report, but there is a material misstatement on the financial statements. Any question on that? So inherent risk. Inherent risk is a risk that something bad will happen. Material misstatement will happen. Few factors go into it. Control risk. Hopefully, if a material misstatement does happen, the client's controls will catch it. If the client doesn't catch it, the last hope is that the auditors will catch it. And if they drop the ball too, then we end up with an audit risk. Okay, so it's detection risk. You want all risks to be low, including detection risk. You want the risk to be low that you miss a material misstatement. So if you think a company has a problem with with the inherent risk and the control risk, are you going to want to raise the detection risk or lower the detection risk? Now, detection risk is a risk that the auditors will fail. So let's say you look at you're going into audit a company, maybe you thought that their controls were pretty good or whatever. You start looking at them and you realize you can't really rely on them. Do you want it to be higher or lower?
High.
Actually, you want it low. You always want lower risk. So, maybe your audit risk was 10%. You try to lower it. You tighten it. Look, if their controls aren't catching it, we got to lower our risk. We got to do more work to lower our risk to do it. So you're always trying to lower it's safer to lower the risk. And how do you lower the risk? By doing more work. The risk that you might miss something, maybe it's at 10%, maybe say, okay, we got to do more work because I can't, these controls are not working like we thought they were. So, we have to do more work on it. So you lower the risk. Lower the risk increases the cost of the audit, right? But it might be necessary to do that. And because you have to get more evidence. How do you lower the risk? You lower the risk by doing more work. Okay, now, there is a mathematical formula for all of this, and this has been on the CPA exam. So we're going to kind of go through it. So this is the formula that they kind of have for it. I'm not sure how many audit firms actually go through this, at least plugging in numbers. Okay, so here we have, for A, we have the inherent risk, control risk, and detection risk. And so we want to figure out what the audit risk is. So the inherent risk is that, again, this is a risk of failure. Failure to correctly account for it. This is the failure risk of the controls catching it. This is the failure risk of the auditors. Oops. More spacing here. And so we want to know what the overall, what's the overall failure risk of the audit. So there's a 40% chance that the material misstatement will occur. There's a 30% chance that the controls will fail, and a 20% chance that the auditors will fail. So what will the audit risk be? Well, we're going to multiply those. I'm just going to do it up here. 0.40 times the control risk of 0.30 times the detection risk of 0.20 equals some number. Yeah. 0.024, or what is that, 2.4%? Okay, so you can see that, as you multiply this stuff out, that as you kind of, all of the, how does a failure happen? It has to occur, 40% chance to occur. There's a 3% that the controls will miss it, 20% chance that the auditors miss it. So you can actually get pretty low percentage of audit failure, even with these that are really pretty high. Those are pretty high numbers. So actually, if they do have, controls and all that kind of stuff, it usually is fairly low for the audit risk, the total failure, even looking at these fairly high looking numbers. Okay, another thing that they like to ask on the CPA exam, or they have asked in the past, is here's your target. What does your detection risk have to be for you to get to this target of 5%? You want this the audit risk to be 5%. So what do you have to make your detection risk? And remember, this is the only one that's controlled by the auditors.
As low as possible.
Well, actually, it's not going to be as low as possible because you could actually spend years doing an audit if you wanted to, and it'd be very expensive to do. I'll give you an example. When Enron went when they had their problems with their financial statements and all that, their audit cost something like 5 or 6 million. When they had to do a complete audit, they had to look at everything because now they know that there's fraud. It was something like 230 million. So we don't do, we don't go overboard on an audit and look at everything generally unless there's a reason to do it. The cost is just astronomical, 20 times whatever, or more, what the what an efficient audit would look like. I look like Dracula, and I realized why. Okay, yeah. So what we're gonna do is plug this into our formula up here, and then just solve it. All right, so we have 50 times 40 times, we'll put D in here for I did something wrong. Stop. And we want this to equal 105. Okay, so we just have to solve it for D. All right. Does anyone already have this? So 0.5 times 0.4 is what? Is that 0.2? Okay, so this will end up being 0.2 times D. So how are we going to solve for this?
You'll have to take 0.05 divided by 0.2.
Yep, exactly. We're going to take both sides. We're going to divide both sides by 0.2. And so 0.2 times D divided by 0.2, so this will be just D equals whatever that is.
Put a footnote to be like, here is your tax basis in this building. Yeah. So that you can report, put like a footnote, so that they know how to, so that, hey, we did everything. The information.
0.25.
Yep, that is it. So our detection risk will have to be 0.25.
I think that kind of helps.
25%.
Because I say this is all, the 1099, that's the all.
So you would do your audit to the 0.25 level.
There is.
Mm.
There is. But they split it, but those people get 1099, that's.
Okay.
Here's your, here's your base.
All right. Any question on that? Okay. One of the sometimes they will simply put all of the risks together for the client. So the inherent risk and the control risk, sometimes they'll just call that, lump it together as the risk of material misstatement. It's nothing any different than what we did up on the top here, but sometimes audit firms will put it into a risk of material misstatement. They'll, to them, this is all the same thing. This is all the client. It's their inherent risk and their control risk, and how we're, separating those out. They'll say, okay, what is the risk of material misstatement? So you just multiply those two together. Oops. What's that? 12%? So this would be 12. That would be the risk of material misstatement. Okay, if the clients see in the about engaged in financial statement fraud, I could probably word that a little better. How would the calculations change? Okay, so suppose you have a client that now is actively cooking the books, making a financial statement fraud. What would the inherent risk be? So let's say they're going to materially misstate their sales. They want to their sales numbers are down. They don't, they're worried about it. What are they going to do? They're going to fraudulently increase their sales numbers. What's the inherent risk going to be? What is it? What's the risk that a material misstatement will occur if they're actively engaged in financial statement fraud? You can put it in chat if you want. You can private me in chat if you want to, so that, if you don't want others to look at it. Yep. Very good, Caitlin. Caitlin, I'm sorry. Yeah, this goes to 100%. It is going to occur. It's 100% is going to occur. They're cooking the books. They're putting things on the financial statements they shouldn't be. Control risk. Well, if they're cooking the book, they're certainly not going to try to catch it. They don't want it caught. So risk of material misstatement, 100%. There's something funny with that. So this is what happens when you're in financial statement fraud. Now, you do run into a problem that if you're not aware of financial statement fraud, your audit may not be very effective. If you're saying at 25%, that means that there's a 25% chance you're going to fail. That's pretty high. 1 out of 4. So if you're not aware of a financial statement fraud, that can be a problem because your audit you may not get as much evidence as you should get to have an effective audit. And by the way, this is one of the reasons why when I was going through, we said, okay, whether the fraud's done by accident, mistake, or whether it's fraud, it really doesn't matter. It's a misstatement's a misstatement, whether it's fraud or an error, mistake, whatever. Doesn't really matter. A misstatement's a misstatement. Well, you can see how that's incorrect, because if we're trying to detect it, whatever these material misstatements are, it matters whether the client is engaged in a fraud or not, because a fraud makes it much more difficult to find, and you have to really bump up the audit. If you want to have, if you want this to be, where am I at? If you want this to be 5% and there's a fraud going on, you have to make your detection risk 5%. You have to do 5 times the audit work, or more maybe, to get it down to this 5%. So you have to do more work so that you can lower this detection risk, lower the risk that you're going to fail down to the same as the audit risk. If there is a financial statement fraud, basically the detection risk is going to be the same as the audit risk, because these two will be 100%. So whatever the detection risk is the same as the audit risk if there's a fraud. So if you do have suspicions that there's a fraud, you really have to go with the audit. Okay, so let's go down to here to this last one. If financial statement fraud is suspected, how will the auditors change their detection risk? I think I already asked this one. So if you suspect, I did ask. You guys already answered it. I'm no reason to make you guys answer it again. So if financial statement fraud is suspected, we'll lower the detection risk. The detection risk is the risk that we will fail. So this will have to be this will be extra work. So we have to do extra work to lower the risk. Any question on that? Okay. I don't know if I'll make this one. Okay. I'm gonna go through the sufficient appropriate evidence. Okay. Auditors are required to obtain sufficient appropriate evidence We'll talk about what that means in a second. To support their audit opinion. The amount of evidence required based on the auditor's inherent risk and control risk. Let me clean this up. Okay, auditors are required to obtain sufficient appropriate evidence to support their audit opinion. The amount of evidence required is based on the auditor's assessment of inherent risk and control risk. Okay, so we use these risks up here to determine how much evidence we need to get. Okay, now I'm going to break down this a little bit more. So sufficient, this is a quantity. This is to me, we need to get enough. And appropriate is a quality. Okay, so sufficient, appropriate. Sufficient means you have to get enough, and quality, evidence. We don't always get the best evidence. We'll find that out later. But we do have to get enough of the evidence, whatever quality it is. We have to get enough at a quality of evidence so that we can have an opinion. I'm going to stop here. I thought I'd get this done today, but plus it's too definition-y. And we're kind of going into a second phase. The second phase is kind of looking at documents. So we'll stop here. So here's what I'm going to do next. I'm going to send out the multiple choice questions. So we'll do those next. And then we'll finish up with a different kind of sampling called monetary unit sampling. Okay, so what I'm going to do now is send out okay. No. And you guys get extra credit points will be added to your exams based on the polls. Oh, I forgot to attach it. Hold on. Okay, so for here we have the extra credit points will be added in based on how you do it. So what I'm going to do is I'm going to go ahead and look stupid for a second. Hold on a second. Where are my polls at? Polls. You know what's weird? It doesn't. It shows it differently on the when I'm sharing my screen. Okay, so you can when you get your the multiple choice questions, you can go ahead and start working on that. When we come back, I don't know, 5, 10 minutes. We'll start going over the poll questions. Let's say at 3. Let's shoot for 3:05. And pull it up on my screen. Let me share my screen. All right, so we'll start looking at these at say 3:05. And once you're done, go ahead and put them into the poll. I think there's 10. I'll check and make sure I'm not lying to you. 10. Okay. Are there still people working on the multiple choice questions? If there are, you can go ahead and put them, you can also put it in chat if you're still working on it. Is there anyone still working on it?
I'm sort of working on 2 questions, but I think I'm just gonna turn it in. I'm not sure.
Yeah, go ahead and start it. That's fine. And these are difficult. They're uh, 75% is what it takes to. Yeah. Okay. Everyone, looks like everyone's in. Okay. Let me end the poll and share the results. Okay. Let's go through here.
Hmm.
Okay. The CP goes. Yeah, B is the right one here. So if there's a contingent fee, and this is if it leads to a loan. And the rest of those are okay. Yeah, so that's a contingent fee. Let's see. What can the AICPA do? They can do everything, but they cannot get rid of your certificate. That's only the state can take care of it, can remove your certificate. Am I in the right one? Yeah. So if Illinois issues the CPA license, just like a driver's license, they're the only one that can take it away. Which fine, what is it most likely impair? B is the correct one. Yeah, that's close relatives and friends, and this is a key financial position. The president obviously could have influence over the financial statements. Okay. Which of the following attributes are more closely associated with attestation services? This is really strange. Do you look at the results on this one? They add up to 167%. I'm not sure what happened on this one, but anyway, independence is the wacky thing. If you look at like doctors and lawyers, they can. If you're a doctor, you can, and your kid gets sick, you can help your kid. I mean, there's nothing wrong with a doctor helping their child. It doesn't work out the same for CPAs. If your kid needs an audit, you can't do it. Lack of independence. So independence is kind of the wacky thing that how do we give our clients, what they need to do it by independence. Okay, let's go to. Are some people answering these twice? It must be. Okay. A CPA, sole prejudice, it's an educational fund for the minor. Okay, purchase stock. Trust security, not material CPA, but material. Would independence of the CPA be considered impaired? Yes, and even one share of stock. Materiality doesn't matter. Oops. The international standards, it would be okay. All right. AICPA allows for which? Performance of bookkeeping. So you can do bookkeeping for your client and do the audit. You cannot do any management jobs if you're the auditor, though. So bookkeeping is simply writing, keeping track of the books, and any journal entries coming out of that, the client will approve those. These authorization of transactions, preparation of source documents, which are like invoices and all that, posting journal entries, those are all managerial jobs, and you cannot do management functions for the client. Okay. I don't know why I got those wacky spacing here. Okay. Oh, I think I must have changed it. Okay. Contingency pricing based on kind of services is B. I'm going to go and pick C or D, though. It's not that they're always prohibited, and it's not that they're never prohibited. They are prohibited for some things. And the joint can be an act as creditable. Yeah, so this will be C is probably the best answer. Put it that way. Which of the following would likely be a violation? C is the right answer. There is one, though, that kind of looks funny there. The tax fee is okay. This is one of the weird things about it. This is one of the things I don't like about our profession is this one. So this is not the right answer. I shouldn't highlight it. But as odd as it sounds, creating forecasts are okay. And the it's a weird thing, but you can actually help them make forecasts that are released, and you can also do. This sounds even crazier. You can actually do audits on forecasts, which I wish would stop. But so and if you think about an audit, what do you do in an audit? You look at what happened in the past. A forecast is things that haven't happened. So there are some kind of wacky rules around forecasting, but forecasting is one of those weird things I wish would just go away, because half the time, a lot of fraud comes from forecasts. People make this forecast, they find out later that they can't make the forecast, they create a fraud so that they can make the forecast. So that's a very common thing that triggers fraud out of these forecasts, and I wish they'd stop that, but I don't think they will. The people who are doing the forecast would say, well, we're trying to help investors to plan, and we want to tell them, what we think the most likely forecast is, but there have been problems with them. And that's not international standards, that's US standards. Okay, which of the following circumstances a covered member be considered independent when performing an audit of financial statements? Yep, immaterial, indirect. Good. Well, one more. If we get this one, least likely to impair. D. Hey, you guys get all. Everyone gets 5. Now, this owing of audit fees, this is sort of like you'd be a lender to the client, which would be an investment. B is not a bad one. A partner in a CPA firm is the son of the president of the client. This would depend on if the partner is a covered member or not. It's possible that it's okay. It's possible that it's not. If they're a covered member, it's a no-no. It doesn't say they're a covered member, but if they were, and that brings up another weird thing about the CPA exam. We always go for the best answer, not necessarily the only correct answer. So if we didn't have D for that one, I would say go with B. D is the second best answer because it could be. Okay, let me stop sharing. I don't like sharing anyways. Let me download the results. Okay. And all right. Next thing we're going to cover, we're going to start on the monetary unit sampling. And I just want to make a small statement on it before I do anything. Monetary unit sampling is a type of sampling that's only for auditors. Classical sampling, we could use that on almost anything. How much do how many cattle are there? That kind of thing. You can actually make estimates, and if you can get a sample, you can project it over the entire population. Monetary unit sampling is only for auditors, and it has some really big advantages. It also has at least one really big disadvantage, but we'll talk about that as we go on. But this is only for auditors, and if you show this to your statistics teacher, they'll probably look at it and say, "Well, what's this?" And but it actually has some real advantages that we'll talk about in a second here. But monetary unit sampling is only for auditing. Hey, that's not what I want. Okay. So monetary unit sampling. And I'm going to give you kind of a visual about what we're going to do here. So we have $5,000 worth of accounts receivable. The cumulative value here, this is adding them all up. So the first one's 500. 500 plus 200 is 700. So this is just adding up all the accounts receivable. We're just adding them up as we go on. 700 plus 600 is 13. You get the idea. So we have 5,000 of accounts receivable, and we're going to pick a sample size of 5 items. Okay, I'm going to switch to my other camera. And be prepared because I usually mess this up. Okay. So here's what we're going to do with this. This is kind of the visual here. All right, so we have accounts receivable for 5,000. And we have 5 items we're going to pick. What we're going to do is break this $5,000 up into what we call, little chunks, little blocks of 1,000 each. So divide by 5 items equals $1,000. All right. By the way, watching this, you probably realize why I do most stuff on the screen. So what we're going to do is break this up into 5 $1,000 chunks. And that's how we get our $5,000. And we're going to pick one item for each of these. And we're going to use that one item to make the value here to see how much this is off by, if it's off by anything. So 1, 2, 3, 4. So we're going to pick 5 items. And each item we're going to multiply. We'll find out how. These chunks. These chunks, by the way, are called intervals. So we have 5 intervals because we have 5 items. And we're going to pick one item to represent that entire interval. The second item is going to have the second. You get the idea. So this is what we're actually doing. This is kind of a visual on it. Okay, so the sampling interval, I just did that, but we have a total of 5,000. I was reading a computer here and I got a bunch of cords. Okay, so we got 5,000. And we're going to divide that by 5 items. Oops. Okay, so our sampling interval is going to be 1,000. Okay, now we have to pick our sample. And you recall that when we did the classical sample, hey, that's not me. You can tell the hair's different. The classical sampling, remember we had that table, we look at the table and we found the first 2 columns. We're going to pick the sample a little bit differently for this one. What we're going to do is, for the cumulative total, we're going to find the one that crosses the $1,000 interval. That's one we're going to pick. We're going to then find the one that crosses the $2,000 interval, 3,000, 4,000. You get the idea. So we're going to pick the ones that actually cross the interval. Okay, so we're looking at the cumulative column here. And which item puts us past the $1,000 mark? Which one puts us past it? Which item? Yep. 3. Okay, so here I'm going to make this green. Okay, so the one that goes past the $1,000 mark is this one. So this is the item we're going to pick, item 3. Which one puts us past the $2,000? Yep, good. 6. So we come down here. Okay, this is the one that goes over 2,000. The one that goes past 3,000 will be the next one, right? So 1,000, 2,000, 3,000, 4,000. And 5,000 will be the last one. So we have 5 intervals, and now we have 5 items. Okay, so the item, so what is this? Item number 3. 6. 7. 9. And 10, and there should be 5 of those. There are. Okay. So here's what we're going to do. So we got our 5 items. Three, 6, 7, 9, 10. So for each of these, we're going to look at what the audit amount is, what the book amount is. We're going to do a ratio. This is sort of like the that's not me. See, I told you to goof this up. Do it every time. I'm watching the clock. All right. So what we're going to do is for each one of those, it's almost like a ratio estimation. We take the audit over the book, same thing, audit over the book for each item, and that's what we're going to multiply by the interval. So it's going to be sort of like a mini ratio estimation one. Okay, so let's take number 3. So number 3, we have a book value of 600. And we have an audit value of 600. Okay, so that one's the same. Okay, so audit was 600. Book value was 600. We're going to multiply it by the interval. The projected value of that interval will be 600 divided by 600 is just 1, so this will be 1,000. And the misstatement will be 0. Everything's fine, right? The audit value is the same as the book value. Okay, let's go to number 6. Book value is 800. The audit value is 560. Okay, so what we're going to do is take 560, audit over book, and divide it by 800. I'm going to color coordinate these. Those almost look festive. Okay, so times 1,000. All right, so 560 divided by 800, wherever that is. Equals 700. Okay, so we're saying that that interval is worth 700. So how much is that interval misstated by?
300.
Yep. So this is going to have a misstatement of 300. We're saying that interval is really only worth $700. So it's overstated, is misstated by 300.
Mhm.
All right, number 7. Audit amount is 450. The book amount is 4. Those are the same. Four 50 divided by 450 is 1. It's misstated by 0. Okay, let's go to number 9. 9 is, let's see, 300 is the audit. 750 is the book. That quick, I forgot. 307. All right, so the interval is 1,000. We're going to multiply that out. 400. And so the misstatement is 600. So again, we're grabbing each of these items we're grabbing. We're going to use those to represent the entire interval. Okay, the last one is 900. Well, 900 and 900. Well, that one's okay. Okay. So let's see. They have $5,000 total for their books. The projected value is 4,100. It's 4,100. And this is misstated by 900. Okay, so this is kind of how we do this method. We're breaking it up into chunks, and we're going to get this projected value. But more interesting is actually projected misstatement, and I'll tell you why. As in real life, when you go through these, the ones that are the same you kind of ignore because there's not going to be projected misstatement. So generally speaking, we would probably only look at 6 and 9 would be the only ones that we would really pay attention to in this, because those are the only two that are misstated. The rest of these, you might, I mean, this example is a little bit contrived, but you may have 200 items, and of those 200 items, there's 4 that are misstated. Well, listing 196 items that are fine, you may just focus on those that are misstated, and that's usually what we do for this method. Now, there is a beauty to this method, though, that is great for us as auditors. Let me show you what it is. Oops, that's not it. That's not it either. Notice something. If you have an item that is larger than the interval, so if there's an item that's larger than $1,000, we are 100% certain that item will be picked. It has to. If it's more than the interval, it has to be picked. Right? So here's the beauty of this method, that if someone is cooking their books, the more they cook their books, the more likely it is they're going to get caught, because it's more likely to be the one that puts it over that interval. And if they cook the books enough, if they increase one of these items enough to be over the interval, it's 100% sure it's going to get caught. So that's why this method is good for things like overstatements. The more they overstate something, the more likely it is to get caught. And even if they spread it over many accounts, the more accounts you spread it over, the more likely it's going to be one of those items that crosses the interval is more likely to get caught. So this method is very good for overstatements. When someone's overstating their books, the more they overstate it, the more likely it's going to get caught. And at some point, if any of those items go over the interval, it's 100% it's going to get caught. So that's kind of the the beauty of this method. Now, you might say, well, what's the downside, right? I mean, that sounds great. The more they cook the books, the more likely they're going to get caught. Anything that is bigger than the interval will get caught. And the more they, for instance, let me do this. For instance, this one is 750. It should have been 300. And if they'd have left it at 300, it wouldn't have been caught. 300 plus, what is that, 3650, whatever. The more they increase it, the more likely it's going to get caught. And at some point, if this would go over 1,000, it's 100% sure it'll get caught. But this one was one of those ones that they bumped it up, and sure enough, it got caught. Here's the downside. This method is great at overstatements. It's useless at understatements. So if someone's understating something, expenses, accounts payable, those sorts of things, if someone's understating them, you do not want to use this method. You probably want to use the classical sampling method, because in this method, the more they shrink something, the less likely it is to get caught. And if they have an accounts payable for whatever, $500, if they shrink it all the way down to 0, there's no chance it's going to get caught. So this is a method that's great for overstatements, terrible for understatements, and it shouldn't be used for understatements. And I'll give you a glimpse into what we're going to do next week. We're going to find that if we do find an understatement, we ignore it because it's not supposed to happen. This is only for overstatements. So it's great for overstatements. This method is pretty much useless for understatements. It doesn't work that way. So again, it's not, while it's ideal for things that are overstated is not as ideal for things that are understated. But now we still have classical sampling. So if you think something is understated, like accounts payable, you can use classical sampling. Okay, I think I'm going to stop here. Let me. I got to share my screen. Okay, let's stop here. Okay, so what I'm going to do next is send out. Let me change this to start. I'm going to send out the Chapter 3 exam. I'm going to look at it before I send it out. Like within the next hour or two, you should get the Chapter 3 exam. It'll be emailed, so check your email for it. I think I already have it set up in. Yeah, there's the drop for it. Okay. All right. So, yeah, so I'll send out the Chapter 3 exam. It's due a week from Friday. I think it's March 1st. It's due. And you should be getting that within, well, let's say, so I'm not lying to you. Let's say like within 2 hours, you should get the Chapter 3 exam. Any questions?
No.
You guys had enough? I've had enough. All right. I will see you guys in a week.
Okay.
See you guys.